Well, what a day for the markets. This was a classic tale of two completely different sessions. We saw this massive rally in the morning, all built on geopolitical hopes, followed by a pretty dramatic fade into the afternoon. Honestly, it was a day that was just full of opportunities, but also a ton of traps. Let's break down what was really moving the money and why.
All right, here's what we've got on tap. We're going to start with the big picture, the major trends and the day's top movers. Then we'll zoom in on a couple of specific stocks that tell the whole story of today's winners and, yeah, some cautionary tales. We'll unpack the geopolitical headlines that caused all this whiplash, hear what top strategists are thinking, and then, most importantly, turn it all into some actionable strategy. And we'll finish up with the day's other big financial news.
So let's get right into it with our first section, today's market trend. On the surface, it looked like a fantastic day. But like the subtitle here says, the way we closed tells a much, much more cautious story.
I mean, at first glance, you see solid green right across the board. The S&P, the NASDAQ, the Dow, all of them climbed over 1%. It pretty much wiped out all of Friday's losses. So you'd think, okay, decisive rebound, right? But the real story, the one that actually matters for tomorrow, is hiding in the details of where we finish the day. Now, the real excitement, if you want to call it that, was in the small cap stocks. The Russell 2000 jumped an impressive 2.3%. That kind of outperformance, that's what traders call a classic risk-on signal. It shows that, for a little while at least, people were willing to get aggressive and bet big on those smaller, growth-oriented companies. But, and this is the big but of the day, here's the catch. Both the S&P 500 and the NASDAQ gave back a ton of their gains, closing right near the lows of the session. And, crucially, they finished below their 200-day moving averages. For so many big institutional investors, that line is what separates a bull market from a bear market. So failing to get back above it, that's a major red flag that the underlying weakness is still very much with us. Okay, so let's move on and see how this whole market trend played out in some individual stocks. We've got a clear winner that's showing some real strength, and we've got a very potent cautionary tale. First up, let's talk about Rush Street Interactive, ticker RSI, which climbed a solid 5% today. Now, this is a great example of a stock showing what we call relative strength. It's thriving while the broader market is just kind of stumbling around. It's in that online betting space, which, feels pretty insulated from oil prices and all the geopolitical drama. Plus, there's some buzz that a regulatory crackdown on prediction markets could actually end up helping established players like RSI. And now for our cautionary tale, Peabody Energy. Folks, this is a masterclass in the dangers of chasing a hot sector in a market that's just moving on headlines. It shows you just how quickly a beautiful breakout can turn into an ugly breakdown. I mean, this is the perfect example of that two-sided coin. On the one hand, B2 broke out to new highs, just riding this powerful wave of surging energy prices. But then, the second those headlines even hinted at de-escalation with Iran, the stock got hammered, plunging from over $41 down to $35 in just 2 days. The rug was completely pulled out, proving that what the news gives, the news can take away even faster. Okay, let's dive into the heart of what caused all this volatility today. It was all about the geopolitical whiplash coming straight out of the Middle East. This timeline just captures the day's chaos perfectly. So it starts overnight. President Trump announces productive talks with Iran, and he pauses an ultimatum. That one piece of news sent futures soaring into the market open. But then, by midday, Iran's parliamentary speaker comes out and denies any talks happened at all, accusing the president of spreading fake news just to manipulate the markets. And that denial? That's what sucked all the momentum out of the rally into the close. And if you want to see the most dramatic reaction, just look right here at the oil market. WTI crude futures plummeted over 10%. It dropped from nearly $99 a barrel all the way down to $88. This huge move just shows you how much of a geopolitical risk premium was baked into energy prices and how quickly it can all just vanish on a single headline. So, with all this chaos, what do the experts make of it? Let's move on and see what the big strategists are telling their clients right now. Steve Sosnick over at Interactive Brokers points to this really powerful force that's still out there, FOMO, the fear of missing out. He says investors have been conditioned for so long to just buy every single dip that their immediate reaction to any good news is to just jump right back in, absolutely terrified of being left behind by the next big rally.
But then you've got Scott Cronert over at Citi, who's offering a much more sober take. He's arguing that we haven't seen a true flush or capitulation yet. That moment of peak fear where everyone just throws in the towel and sells, volatility spikes, and a real market bottom can finally form. His view is that we've still got more downside to work through before a sustainable rally can even begin.
And finally, Michael Kantrowitz at Piper Sandler, he kind of boils it all down to just one thing. He says right now this is a one-variable market, and that one variable is oil. The price of crude is driving absolutely everything: bonds, interest rate expectations, and of course stocks. The big takeaway here is that until oil finds some stability, we should probably expect the whole market to stay pretty volatile.
So the big question is, how do you navigate a market like this? Let's transition over to our outlook and strategy section, where we can turn some of this analysis into a few actionable ideas. So here is the landscape right now. The key risks are pretty obvious. Another headline comes out and reverses today's news, oil shocks reignite inflation, and a lot of those eager dip buyers get caught on the wrong side of a trade. But on the flip side, all this volatility creates some really interesting opportunities for patient investors. Buying when fear is at its highest, slowly accumulating shares in oversold market leaders, and scaling into your positions instead of going all in at once. Now, to help manage that risk, let's talk about a specific tool called the Average True Range, or ATR. It sounds a little complicated, but it's not. All it does is it measures a stock's typical daily price swing. And in a choppy market like this one, just understanding how much a stock normally moves every day is an incredibly powerful piece of information to have. And here's how you can actually use it. First, you can screen for stocks with a lower ATR if you're just looking for more stability. Second, it really helps you set a logical stop loss. A common pro strategy is to place it one full ATR below your entry price. And third, and maybe most importantly, it lets you quantify your risk up front, which helps you figure out the right position size before you even place the trade. All right, finally, let's round things out with our last section, just a quick look at a few other major headlines that were moving money around today. First up, the private credit giant Apollo is actually limiting investor withdrawals from a $15 billion fund. That could be a sign of stress in that really hot market. Second, reacting to some regulatory pressure, prediction markets like Kalshi are now moving to block insiders, like athletes, from betting on events they could directly influence. And finally, JP Morgan's CEO Jamie Dimon voiced some deep frustration with slow government processes, especially in military procurement. And all of that brings us to our final question for the day. In a market that is swinging so violently on every single new headline, what's the greater risk here? Is it chasing these quick, fleeting rallies and getting caught in a painful reversal? Or is it being too timid and missing the powerful opportunities that are so often born from these moments of maximum fear? That's really the central question for every single investor tonight. Thanks so much for joining us.